My name is Tom Smith, and I'm the VP of Full Service Investment Trading here at Trade Monster. And Chuck today is going to be giving us a presentation. It's really part two of his presentation regarding his market volatility profit secrets and some of the things that he's discussed in prior webinars. Now, we do a lot of free educational webinars on mytrademonster.com. You'll actually see this archive tomorrow afternoon. If you have any questions, please put them in the question or the chat area. I will try my best to get Chuck those questions as quickly as possible. Obviously, a lot of people like to ask a lot of questions. We won't be able to get to each one, but we'll try our best. Otherwise, Chuck's going to put up some of his information at the end of the slide presentation. If you need to contact Chuck or Chuck's people regarding questions or his programs or some of the trading strategies that he's utilizing just to get a little more different answer, Chuck and his people can help you out with that. Otherwise, without further ado, Chuck, why don't we go ahead? Thank you very much for taking the time again and joining us again today.
Okay, great. Thanks, Tom. It's great to be here, everybody. The subject today that we're going to discuss is market volatility profit secrets, which is very apropos for the current market conditions. And I just wanted to mention that everyone attending today can get a free copy of my Stock Market Magic book. We're making that available to all attendees. So
just for those of you that don't know, Chuck, we'll go ahead and we'll fulfill that. Just as long as you put your email down in the registration area, Chuck will get those sent out to you probably sometime tomorrow afternoon. Thanks, Chuck.
Okay. And today we want to look at strategies that have been working well with the current market volatility. And I've got some screenshots of the S&P 500 index here. And you can see a lot of volatility in the S&P, and but no clear trend. And in this particular snapshot from February through July, even though we had these wide price swings, the S&P is virtually unchanged over that time frame. So a lot of volatility and no trend. So the question is, how do you trade this type of market? If you take a long or short position in this type of volatility, you could easily get stopped out of your position if you use a money management system. So I've got some strategies I'm going to show you today that are ideal for these types of market conditions. Here's another snapshot of the S&P. This is from last summer, and a summer a year ago, 2010. And again, you can see a lot of volatility, but the S&P is virtually unchanged despite the wild price swings. So we went through this same type of volatility a year ago this past summer. Here's one more recent snapshot, and again, a lot of volatility and no clear trend. So let's talk about how we can profit in these types of markets. And I have several volatility strategies. The first one we're going to talk about is the married put, where you purchase stock and purchase a put option. And this trade can be done simultaneously. In other words, you can buy a stock or an ETF and purchase a put option at the same time. Or if you have a stock position or an ETF position and you have a profit in it, you can always buy a put to protect your stock position. So with the married put, we purchase a put option and we purchase stock. The second strategy is covered calls, and again, this type of trade can be done either simultaneously by buying a stock and selling a call option, or if you currently have a stock position, you can sell a call option against it to give you downside protection in case of market volatility like we're experiencing lately. And another great volatility strategy is the option spreads. And if you own a call option, and you have a profit in it, you could sell a call option at a higher strike price and create an option spread, and this would provide downside protection on your call option purchase. Also, you can trade in-the-money option spreads, and these, depending on the strike price and how deep you're in the money, can give you a lot of downside protection and still provide a good return. And one other volatility strategy is to sell weekly option premium to generate cash income. And we'll take a look at some examples of that here in a minute. So the overall goal of the volatility strategies is to increase the profit potential of your directional stock or option trade. And in other words, if you just own a stock or you own an option, and if you sell a call option or buy a put option, this could increase your profit potential of your current position. And again, we want to provide downside protection for our stock or option trade. Now, if you're short a call option, of course, that call option will profit as the stock moves lower in price. So that's how you provide downside protection for your stock or option position. And the volatility strategies, they help you maintain your position during volatile markets and wide price swings and avoid being stopped out of your position. Obviously, that's very important. You're all aware of the recent market volatility, and this is one way that you can maintain your positions during that volatility without getting stopped out. So let's look at the first volatility strategy. It would be the married puts. And again, a married put is initiated by purchasing stock and purchasing a protective put option. And I have a brokerage confirmation here of a trade I made recently for the QQQ, the NASDAQ ETF. And this brokerage confirmation shows I bought 800 shares of the QQQ at 54.35. And at the same time, I also bought 8 QQQ January 12 55 put options. So buying the put option, it's considered what they call a married put to your ETF position, and the put protects your ETF position in case the ETF goes down in price. And let's look at the math for a married put. Again, I bought the QQQ at 54.35 and bought the January 12 55 put at 4.11. And there was about almost 5 months until option expiration when I did this trade. So the total cost of this married put was 58.46 points. Now, once I purchased that 55 put option, the value of my ETF will not go below 55. So if we take the cost of 58.46 and subtract the floor that's placed in there from the put of 55, we see that the maximum risk for this trade is 3.46 points, and that's about a 5.9% risk on my purchase price. And the break-even point for this trade is if the QQQ goes up 7.5%. In other words, you need a 7.5% price move for this married put to start showing a profit. So it's a trade-off. I mean, you're getting very low-risk trade, but the trade-off for that is the QQQ in the next 5 months has to increase 7.5% in price in order for this trade to become profitable. And here's a graph of this trade, and you can see the maximum loss is $346. And once the QQQ starts going above 55 in price, it starts to reduce our maximum loss. And of course, once it gets to 58.46, it breaks even, and then anything above that is profit. So if you hold the married put till option expiration, then the maximum risk again would be 5.9%, but your return is not limited. In other words, if you by purchasing a put option, unlike selling a call option, if you purchase a put option, your upside is not limited. And here's some more examples of married puts I put on recently for the NASDAQ, the emerging markets ETF, the small cap ETF, Apple, and Baidu. Now let's talk about the trade management choices once we put the married put trade into place. And we have several choices here. If the QQQ increases in price, a call option could be sold at a later date, which could guarantee a profit on the trade. So I'm always looking for to sell a call option against my married put to lock in a profit. So that's one option you have, one trade management option for a married put trade. Another option would be to sell weekly call options against your married put. And right now the weeklies are returning about 2% time value for that 1 week trade. So of course when you sell a call option with 2% time value, you get to keep that time value regardless of which way the price of the underlying stock or ETF moves. So the put option I currently have in place expires in about 21 weeks, and if you do the math on that, a 2% return per week times 21, has the potential to deliver 42% return. And of course, the last option would be if you simply hold the married put till expiration, the upside return is not limited.
Chuck, do you favor weeklies over monthlies, or vice versa, or does it just depend on your position?
I like to mix it up, Tom, to answer your question, and I do a combination of both, just for diversification purposes.
Okay.
I do the weeklies, I do the monthlies, and also longer term buy right trades also.
Okay.
So now let's look at a possible scenario for this QQQ married put trade. Let's say that the QQQ moves up in price between now and the 5-month expiration, and if I sell the 60 strike call option, let's just assume I could sell that at 7 points, just for academic purposes, and we'll see what kind of return we could potentially have from selling a call option. So our cost for the married put, as you recall, was 58.46. So if we sell a call option for 7 points, this reduces the cost to 51.46. And if the QQQ closes at 60 or above at option expiration, we would take the 60 strike price and subtract our cost of 51.46, and we wind up with a 8.54 point profit. And if we divide that by our 51.46 cost, we would get a 16.6% return. So this is just an example of the potential of selling a call option at a later date on your married put position. Now here's another choice, selling weekly options, and here's a brokerage confirmation where I sold 8 of the QQQ 53 strike weekly options at 1.18 points, and that premium of 1.18 points translates to a 2.2% time value for that option. That was an at-the-money option. So my weekly return for that would be 2.2%. And again, if any time value in an option that you sell becomes profit at option expiration. So if we assume that I got a similar premium each week, 1.18 times 21 weeks, it has the potential to deliver 24.78 points of profit, and in percentage terms, that would turn out to be 46.2%. Now, of course, we have to subtract the cost of the put, which was about 7.5% from this total profit to get a net profit. So this is the potential for this trade for selling weekly call options, assuming that the time premium is about the same each week. So that's one of the choices we have with the married put position. So to recap, the advantages of the married puts is your risk is strictly limited, and in a lot of cases the risk is very low for these trades. Anywhere from 4, 5, 6, 7% is your maximum risk, no matter what happens to the price of the underlying stock or ETF. Another advantage is we could sell a call option at a later date, which can, depending on the strike price, can lock in a profit. We could also sell weekly call options against our married put, and most importantly, the married put allows you to maintain your positions during volatile markets and avoid being stopped out. So obviously that's very important during the current market conditions. And you saw those graphs of the S&P 500 index, and you know that it's pretty tough sometimes with this volatility. So this is one way to maintain your position with low risk and avoid being stopped out. If you hold the married put to expiration, then your risk is limited, but your upside potential is not limited. And I want to talk about one other twist with the married puts, and that's buying a dividend-paying stock and purchasing a put option. And the theory here is the dividend you receive can help pay for part or most of the put option protection. So this is a very low-risk trade on some of these dividend-paying stocks. And I'm showing some examples of married puts I did on dividend-paying stocks, and we'll take a look at the risk and return potential for these married puts here. And first one we'll look at is Royal Dutch Petroleum, and I purchased the stock at 60.12 points. I purchased the 60 strike put option, as you saw in the brokerage confirmations I just showed you there. I purchased the 60 strike put at 5.50 points, and the annual dividend is 2.70 points, or $270 per 100 shares. So what I do with my calculator is I can calculate, assuming that the quarterly dividend is maintained and the annual dividend is 2.7, assuming that that takes care of a large portion of the cost of the put option. So you have a very low risk trade. So based on that assumption, and this particular put option had about let's see, it had about almost 22 months of protection. So this is a 22-month trade, and your maximum risk during that 22 months was $90, or 1.4% of the cost of this married put. So as you can see, that's a very low risk trade, and any time over the next 22 months from when I initiated this married put, if the underlying stock goes up, then I could realize a good return on this position. And we can see I circled, even if the stock drops to zero, which is very unlikely, you can still see our maximum risk is $90 on this trade. So this is a great strategy because the dividend will pay a large portion of the put premium in this case, and allow you to take a very low risk trade. Here's another example for Bristol Myers Squibb, and the maximum risk on this trade was $108, and the percentage risk is 3.9%. So this is about a 21-month trade, and again, in that 21-month period, that gives you a lot of time for this stock to go up in price. And in the meantime, if it doesn't, your maximum risk for 100 shares in one put option is $108. And here's another one for Duke Energy. And in this example, our maximum risk was $133, and our percentage risk was 4.3%. So this is a good strategy to implement during volatile markets, because no matter what happens to the stock price, your risk is very low. And I just wanted to show a snapshot. This is from my advisory service. The open trade results, I think this is either yesterday or the day before. I took a snapshot of the open trade results for the married put portfolio, and we had, at that time, we had a $51,634 open trade profit, and our percent return was 45.5%. And I circled one of the real estate investment trust positions we have in this portfolio, just to demonstrate, again, the value of the dividend covering the cost of the put. And this is for American Capital. And we purchased the stock and then bought the January 13 25 strike put option. Now, the cost of the put option was $6. And American Capital pays a 1.40 point quarterly dividend. So there's 6 quarterly dividends before option expiration. So we're actually going to collect, if they maintain that quarterly dividend, we're actually going to collect 8.4 points in dividends, which will actually cover the full cost of the put protection and then some. So again, this is a very low risk trade because the dividend covers the cost of the put option. And
Chuck, in identifying these low risk trades, are you trying to identify companies that pay dividends for that exact reason, to cover the put cost?
Yes, yeah. Now, the married put can also be done on stocks that don't pay a dividend, but you know, part of our portfolio is to include dividend paying stocks, because it can be a really low risk strategy. So to answer your question, I do the married puts on both dividend paying stocks and stocks that don't pay dividends. But I was just trying to focus on the dividend paying stocks and how that can really reduce your risk. So so the portfolio is a combination of both types of stocks. And one other choice you have would be, with this American Capital married put, would be to sell monthly call options against the married put. And here's an example. This option has a little more than a month to go before expiration, and it's producing about a 2% time premium. So over the 16-month length of the trade, if you collected a 2% time premium each month, it has the potential to deliver a 32% return. And again, the cost of the put option in this example is completely covered by the dividend. So again, another low-risk volatility strategy. And let's talk about our next strategy, which is option spreads. And option spreads are created by purchasing a call option and selling a call option with a higher strike, or purchasing a put option and selling a put option with a lower strike. It's called a debit spread, and your risk with a debit spread is limited to your purchase price of the spread. So here's an example of a option spread I put on recently for Apple, and this trade is actually I still hold this. This is still an open position for me, this trade. So I purchased the October 345 strike at 28.17, and I sold. Then 10 days later, I sold the Apple 375 strike call at 24.55. So I had a profit on my call option purchase. So the prudent thing to do in these types of markets is to sell a call option to protect your profits. And a lot of good things happen if you do this, as we'll see in a minute. So this is one of the ways that you can trade volatility, is to protect your call option position, is sell another call option. And we'll look at the advantages of that here in a second. And again, this trade is still in effect, and this is still an open position. Now, let's look at the call option spread analysis for this trade. And I took this snapshot a couple days ago when Apple was trading at 420.20, and the call option spread analysis will give you a profit loss potential for this trade based on the price of Apple stock in this example at October option expiration. And the top row here in the table, we list the percent change of in the price of Apple stock, from a 20% increase in Apple stock to a 10% decrease in Apple stock. So, and then the bottom row of the table shows the spread percentage return, and this row has the potential return for the Apple stock, or the option spread based on the price of Apple stock at option expiration. So if Apple stock is up 10%, this spread would produce a 728% return. If Apple stock is flat, it produces a 728% return. And if Apple stock goes down 10%, it still produces a 728% return. So you can see with the option spreads that you can profit if the stock goes up or down in price, depending on the strike prices you selected. And again, this is based on the stock price a couple days ago at 420.20. So you can, this is a great strategy during volatile markets because it allows me to maintain my position even though there's a lot of market volatility or wide price swings. So let's talk about the advantages of an option spread versus an option purchase. One of the advantages is if you own a call option and you have a profit in it, and you go ahead and sell a call option against your current purchase, it increases the profit potential of your option purchase, and we'll look at an example of that here in a minute. So the spread can actually increase your profit potential, and the option sale provides downside protection because the short call is going to profit as the stock moves down in price. It reduces your overall risk because when you sell a call option, you receive that premium for the short call as cash into your brokerage account. So this reduces the risk of your trade and reduces the dollar amount that you have invested. And it allows you to maintain your positions during volatile markets, obviously very important right now. And the spread can be profitable depending on the strike prices if the stock goes up or down or is flat. And here's an example of a Conoco spread that I did. And I initially purchased the Conoco January 12:45 call, and I had a profit in the trade. So I went ahead and I sold the Conoco January 12:67.5 call. So this increased the profit potential of my option purchase by 72%. In other words, the selling the 67.5 call increased at the time that current profit potential of the 45 call purchase by 72%, and it lowered the cost of the spread from $1,535 to $895. So increased the profit potential and lowered the risk. And here's a call option spread analysis for this trade. And we can see if Conoco stock price stays flat, this spread produces 151.4% return. If Conoco stock drops 20%, it produces a 80% return. So again, another example of a good strategy to use during volatile markets. And I'm looking at the option spread open trade results for my advisory service. This was as of 2 days ago, and the portfolio had an open profit of $164,294 and an average return of 120.5%. So these spreads obviously have a lot of downside protection for the volatile price swings, and most of these would be profitable even if there's a very steep decline in the price itself, in the price of the stock. So again, these increase your profit potential of the call purchase and also provides substantial downside protection.
Chuck, real quick question for you regarding your option spreads.
Yeah.
A couple of questions regarding this. Do you typically purchase both legs of your spreads at the same time, or will you leg into these?
Yes, that's a great question. I actually do both. Sometimes I'll initiate both sides of the spread simultaneously. Other times, if I have a call option purchase and it's profitable at a later date, I'll sell a call option against that purchase to create a spread. So to answer your question, I do it both ways. And the spreads that provide the most downside protection and the most percentage return are the spreads that are legged into after you have an existing profit in the call purchase. And we saw that with the Apple spread that I have on right now. I sold the call option 10 days later because I wanted to protect those profits and increase the profit potential. And we saw that spread had a 728% return potential. So to answer your question, Tom, we do both. And if you leg into it with a call with an existing profit, it's going to give you more downside and more potential return.
Okay, so it's all depending on what kind of risk you're looking for as an individual.
Yes, yeah.
Okay, okay, great.
And here's a snapshot of one of my option spread portfolios, and this portfolio had a $175,000 open trade profit and average return of 95.7%. And this is a well-diversified portfolio in many different industries. So lots of, and with this portfolio, I had both types of trades. I had trades that I legged into at a later date on an existing purchase, and I also had trades that I initiated simultaneously by buying a call and selling a call. Okay, and another strategy I'd like to look at today is the buy rights versus a stock purchase. And the buy rights are kind of similar to the option spreads we just discussed. The difference being you're buying a stock and selling a call option. So again, this can be done simultaneously by buying a stock and selling a call option, or if you have an existing stock position and you have a profit in it, you can always sell a call option to protect your profits. So, so the advantages are similar to the option spread. If you have an existing stock position and you sell a call option against it, it can increase your profit potential. And of course, the option sale provides downside protection, and the short call is going to profit as the stock moves down in price. Reduces your risk because, again, if you sell a call, then the premium you receive for the call is going to be cash that's credited to your brokerage account. So this reduces your cost basis of your stock. And it allows you to maintain your positions during volatile markets. And the buy rights can be profitable if, depending on the strike prices, if the stock goes up or down. And here's an example. This was a simultaneous buy right where I bought 300 shares of Petrobras and sold 3 of the Petrobras January 25 strike call options at 658. So I purchased the stock 2308, sold the call options at 658. So let's take a look at the return potential for this buy right trade. And in the buy right analysis, we look at the profit potential for this trade based on the price of Petrobras stock at option expiration. In this table, I inputted the change in price from a increase of 15% to a decrease of 15%. So let's look at the potentials here. If Petrobras stock goes up 10% at option expiration, this spread would return 51.5%. If Petrobras stock was flat at 2308 at expiration, it would return 39.9%. And if Petrobras stock went down 15%, it would return 18%. So let's think about that a minute. If the stock goes down 15%, you make 18%. That's pretty good. So again, this is a great strategy for volatile markets, and it allows you to maintain your stock purchase through some wild price swings depending on the strike price. So another great strategy for volatile markets. And I took this snapshot. This was a Mosaic buy right, and I bought 1,500 shares of Mosaic and sold 15. I believe this was a 40 strike calls, and after I initiated this buy right, the price of Mosaic stock went down. It went down as much as 12 to 15% while I was holding this. And normally, if you use a money management system, you're going to exit a stock if it drops, 10 to 15% below your purchase price. So in this example, Mosaic stock dropped about 15%, but I was able to maintain this position through the price downswing because I had the short calls protecting the position. And when I took this snapshot, Mosaic stock was still down from my purchase price, but the buy right had a net profit in this example of $3,553. So that's an example of the stock going down in price, but you're still maintaining a profit, a net profit for the buy right trade. And here's a snapshot of one of my buy right portfolios. This one has $323,000 in open trade profits and average return of 54.8%. And here's the my advisory service buy right portfolio, and this is as of 2 days ago. The portfolio has had a $193,000 open trade profit and an average return of 85.9%. And again, these buy right trades have substantial downside protection. So even if these stocks drop dramatically, almost all of these trades are going to be profitable.
Chuck, is it typical for you to hold your options until expiration, or does it depend on each individual spread due to market volatility?
What I usually like to do is take profits if it reaches 90% or more of the profit potential, and that can be calculated. And if it gets close to the maximum profit potential, I'll just take profits, whether it's a option spread or a buy right trade.
So you're looking at a 90% threshold then for profit potential.
Yes, yeah. If it reaches 90% or more of the potential profit for that trade, then I'll exit. So that concludes our the Market Volatility Profit Secret webinar. And if you'd like to get updates for these various strategies, if you log on to chuckhughes.com and click the trade results tab, I have the current trade results for the various option spread and buy right and married put strategies. So anyway, I want to thank everybody for attending, and I'd be glad to take any questions at this time.
Yeah, Chuck, thank you very much for putting on a show. A lot of the people that are asking questions, if you want to review how Chuck actually comes up with a lot of these trades, you can actually go to mytrademonster.com, and I have Chuck's webinar archived from 2 weeks ago. Chuck, I know that you get a little more descriptive in looking at your Keltner channels and things of that nature, and that may be able to give some people a little bit of an indication on how you come up with some of these picks. I know this is a little bit of a different strategy for you, but coming off, is there any one particular media outlet or something of that nature that you'd like to utilize to go after some of these stock picks?
You mean as far as the stock selection?
Yes, correct.
Well, I outline the stock selection process in my Stock Market Magic book that everybody can receive as if you attended the webinar today. And in the Stock Market Magic book, I list the websites I use to download the stock selection information, such as moving averages and the Keltner channels and new 52-week highs. So I outline the websites that I like to use to obtain those indicators, And that's all described in the Stock Market Magic book.
Okay, great. For those of you that do want to listen to Chuck's other webinar, this is the My Trade Monster site where we have a lot of these webinars archived. Up in the right-hand corner, you'll see September. That was 2 weeks ago. We also that's going to be describing some of Stock's picks, or excuse me, Chuck's picks regarding his stocks you get utilizing Keltner channels, etc. So you can go ahead and click on there. That'll also have Chuck's information if you have any questions for them. We will go ahead and we will send everyone the booklet via email, PDF file sometime. If not tomorrow, it should come within the following business day or two. For those of you that do want to ask Chuck questions, he's got a great team out there, and you know, I know that they're pretty punctual, Chuck. So I'm sure I have some questions I'll be forwarding over to you moving forward.
Okay.
But again, for those of you that didn't get to hear Chuck's webinar 2 weeks ago, which gives the first half of this, again, go to mytrademonster.com, go to free education, and we have Chuck's webinar linked up here under September. So I hope that helps everyone. Chuck, one last question. Al keeps asking the question, how do you determine what percentage of your account to assign to your each recommendation at this point?
Well, every trader is different, has a different risk tolerance, and you know, that's going to depend on your risk tolerance and how much funds you have, and whether you need the money for any kind of short-term purchase, and you have to pull money out of your account. So in my personal trading, I like to allocate it with several of these strategies so that I diversify my risk. I have the married puts, I have the buy rights, and I have the option spread. So I trade all three of the strategies that I just presented.
Okay, that's a perfect answer, being a money manager myself. Again, you want to look at yourself, your objectives, what kind of risk you're willing to take on, and then figure out your ratios from that point moving forward. Chuck, again, thank you very much for coming in this week. That was the second one in 2 weeks. We're getting a lot of great comments. I will be forwarding you everyone's information so they can go ahead and fulfill the Stock Market Magic book to them.
Okay.
Otherwise, for those of you that don't know, Chuck is going to be actually attending Invest Like a Monster seminar down in Florida on November 11th and 12th. I believe you're speaking on the 12th, Chuck, with the guys from CNBC?
I believe so, yes.
Okay, Chuck's going to be giving a seminar with the guys from CNBC, the Nigerians, Guy Adami, the Fast Money crew. And they're going to have a panel at the end. So for those of you that can make it out to Florida, it's going to be a real interesting event. You'll get to meet Chuck firsthand, shake his hand, palm press with him, if you will, a little bit, chew his ear off a little bit. Chuck, I hope you have your ears ready.
Yes.
And nonetheless, for all of you that do have any kind of curiosity in joining us, just send me an email. I'm Tom Smith. I'm this good-looking guy up here at the top. But nonetheless, you can go ahead and you can get a hold of us. Our mytrademonster.com also has a MyTradeMonster and MyTradeMonster email. So you can go ahead and send it to me, and Chuck, I'll forward off the inquiries over to you moving forward.
Okay, that sounds good.
We're past that hour here. I just want to thank everyone for their patience at the beginning. What city, Roy? That's going to be down in Fort Lauderdale, Hollywood, Florida. So again, for those of you who joined, thank you very much for coming and attending today. Chuck, thank you very, very, very much for giving us your time and that insight today.
Okay, glad to be here. Thank you, everybody.
Thanks, everybody. And if you have any other questions, again, you can go to mytrademonster.com. Again, my name is Tom Smith. I am the VP of Full Service Trading here at TradeMonster. If you have any questions regarding trading, we have a disclosure area within our website. These will answer just about any questions you may have. If they don't, feel free to contact us here, and I'd be happy to address any of your questions. Otherwise, everyone have a great night, happy trading, and trade like a monster. Good evening.
Good day.